All right, let's set the scene. It's March 2026. Oil prices have just blasted past $120 a barrel. But here's the thing. This isn't just another energy crisis. No. What we've all just lived through is a fundamental repricing of global risk. So let's break down exactly what happened, and more importantly, what it means for your portfolio. You know, when the International Energy Agency, we're talking the world's energy watchdog, says something like this, you stop and you listen. This wasn't just some price spike. The IEA was sending a massive signal that the fundamental plumbing of the global energy system had literally broken. The sheer scale of this event, well, it puts it in a category all by itself. So, how in the world do we make sense of all this chaos? Here's our game plan for today. First, we're going to tackle the sheer scale of the supply shock. Then we'll dive deep into how the market reacted. After that, we'll uncover a hidden crisis the headlines completely missed, map out 2 potential paths for the rest of the year, and finally, we're going to rewrite the investment playbook for this new reality. Okay, first up, let's put this supply shock into perspective. Because to really understand just how seismic this event was, you really got to look at the history books. Just take a look at this. You remember all those energy crises from the 70s? The ones that are kind of seared into our collective memory? Well, they look like minor tremors compared to this thing. The closure of the Strait of Hormuz took 20 million barrels per day offline. That is more than 3 times the disruption of the 73 embargo and the 79 revolution combined. This wasn't just a disruption. It was a sudden, absolutely catastrophic stop. So how did the markets react to an event of this magnitude? I mean, what happens? Well, we can basically dissect the entire meltdown by looking at 3 core pillars: price, volume, and volatility. First, let's talk price. Brent crude absolutely exploded by over 60% in a single month. This wasn't some gradual climb, it was a vertical, panicked repricing. It marked the single largest monthly gains since the futures contract was even created. That is just pure, unadulterated velocity. But the pain wasn't just in crude oil, oh no. The shockwave ripped through the entire energy complex. European natural gas spiked nearly 90%. And just look at Asian jet fuel, it more than doubled. This wasn't some isolated event, it was a full-blown systemic crisis. Now in the stock market, this triggered what Wall Street calls the Great Rotation. This is when capital just flees from one sector to another in a panic. Money poured out of those growth-oriented sectors, like tech and consumer discretionary, the engines of the recent bull market, and it just rushed into defensive havens, like utilities and, of course, energy. This wasn't just a little bit of selling, it was a fundamental shift in risk appetite. But here is where it gets really interesting. Because while all the headlines were screaming about $120 oil, the smartest investors were looking at a much deeper, more structural problem. So, what did the markets miss? What was the hidden signal? Well, the answer lies in the difference between a simple disruption and the outright destruction of capacity. See, the oil market, while it was totally shocked, it had buffers. It had a safety net. The IEA coordinated a massive 400 million barrel release from strategic reserves. But the liquefied natural gas market, it has no such buffer. It's a fragile, just-in-time delivery system. And here's the crucial part. The crisis didn't just block LNG shipments. It involved the physical destruction of export facilities in Qatar. You can't fix that by releasing reserves. Rebuilding that infrastructure could take up to 5 years. That right there is a multi-year time bomb that the market is still seriously underappreciating. So what happens now? Where do we go from here? Looking ahead, we really see 2 primary paths for the rest of the year: a de-escalation bull case and a prolonged conflict bear case. Okay, in the bull case, diplomacy actually works, the Strait reopens, and oil prices fall back toward that $70 to $80 range. The hit to U.S. inflation would be pretty muted. But in the bear case, the conflict just drags on, the Strait stays partially closed, oil averages near $100, and warflation, that's inflation driven by geopolitical conflict, it becomes entrenched, and it cuts global GDP growth by a full percentage point. So, what does this all mean for you as an investor? This is, without a doubt, the most important part. The biggest takeaway from 2026 is that the world has changed. Geopolitical risk, it's no longer a temporary bug. It's a permanent feature of the market landscape. You know that old playbook of just buying the dip in broad market indexes? It's not enough anymore. It's insufficient. The new reality demands a portfolio that's actually built for a world where this kind of strategic competition and these regional conflicts are persistent drivers of market returns, not just some temporary shock you can ignore. So, what does that actually look like in practice? Well, it means increasing your exposure to themes that can actually thrive in this new paradigm. We're talking about defense, security, and aerospace, where government spending is pretty much set to drive multi-year demand. And we're also talking about industrial resilience, companies focused on securing supply chains and bringing manufacturing capabilities back home. The events of 2026 were a massive wake-up call, and they proved that the era of stable globalization is over. So the real question you need to be asking yourself now is this: is your portfolio built for a world where crisis is the new normal?